What's up, everyone? I hope you're having a good night. As you all know, Jerome Powell released the CPI data on February 10th, 2022, showing inflation up 7.5%, with interest rates still down low since the Feds are not positioned to start raising interest rates until March of 2022. Now, what this has done is light a fire under Jerome Powell's rear that he needs to act fast. In my opinion, inflation is only going to continue getting worse, and the Feds are going to need 2 rate hikes in March. They're really going to need to start acting fast to offset inflation, and in my opinion, they're going to need around 6 or 7 rate hikes to offset inflation this year, because it's just simply going to get out of hand. Now, I'm going to step out of the way and let you look at the screen as I review what we're going to be going over. Now, we're going to be talking about, in high interest rates, sectors that benefit, which is why I previously recommended Sophie, and I'll try to get other videos on other stocks in the financial sector. With that being said, I'm a single parent, so I get out the videos I have time to get out. Also, keep in mind, this is not financial advice. Trade and invest at your own risk. We're going to talk about sectors that benefit from inflation. We're going to talk about mortgage rates rising and how mortgage rates rising as well as interest rates rising may affect the housing market, and how that's a warning sign for the housing market. Obviously, if the housing bubble pops, that's really bad for the stock market as well. We're going to talk about moving forward, an inflection point that may come by looking back at past charts about inflation, disinflation, and deflationary cycles. We're also going to be reviewing historical charts of U.S. inflation and how the stock market reacted. Again, if you want to see forward, you need to look backward. Looking forward, we're going to be talking about deflation's economic spiral, the Kondratiev seasons. We're also going to highlight the difference between disinflation and deflation, as well as the difference between an economic crisis and a financial crisis. And I would like to say, I think it's interesting how the Fed narrowly avoided stagflation. We will be talking a little bit about stagflation and exactly what stagflation is. Basically, stagflation is when unemployment is high and inflation is also high. Now, this is a type of inflation that is the most difficult for the Fed to recover from. Now, when employment numbers magically tripled from December to January, this narrowly avoided a period of stagflation. So we're going to be discussing a little bit about what stagflation is. We will also be talking about where to invest during the deflationary cycle and charts with and I'll step aside in case anyone wants to see this chart. But we're going to be reviewing charts with recession indicators that include the inflation rates over time with deflationary episodes and the U.S. inflation rate in post-recession periods. Again, I realize this is looking forward, but the goal is to be prepared, not surprised. And again, we're going to review charts of historical U.S. inflation, as well as where the stock market crashed, as well as where the housing bubble popped. Now, you know, these past occurrences are not an exact indicator of where it will happen on the future, but you do have to look backward to get somewhat of a feel for what to expect. So we're just going to kind of look over some of this stuff here. And again, we're going to highlight the difference between an economic crisis versus a financial crisis, so we can identify the difference moving forward, because again, I just think we're moving into, it's just not looking good, to put it simply. We're going to talk about the Phillips curve, which shows the short run trade-off between inflation and unemployment, which we'll get more into, but the inverse relationship, negative correlation between the rate of employment and the rate of inflation. And, you know, understand that with this Ukraine-Russia conflict, that's why I suggested investing in oil. I know Barron's was reporting yesterday that that's the #1 sector to invest in now. That's why I was talking about investing in oil. And keep in mind, that's why I always say, you know, I'm a single parent. I get out as many videos as I have time to, But again, I think that's a great sector to get into right now. Obviously, when interest rates starts rising, again, the financial sector. So that's why I was recommending Sophie. And, with what I believe will be 6-7 rate hikes this year, where do you want to go? The financial sector. And again, oil. So there's two sectors right there for you right now. So, I'll get out as many videos as I can, but research is key. And, we're going to keep it moving here. But again, anyone that's been watching, I made a lot of predictions, but I warned in last November, anything you're up on, depending on the average cost of the company, whether it's a small or mid cap, if it's risky, consider selling it, getting put options. Anyone that has listened, if anyone is interested, you can take screenshots. But basically, this is what I was referring to. I was warning about in November, and obviously, I'm not going to read through all of this information because we need to keep it moving. But if anyone wants to take any of this information, screenshot it, that's fine. Again, anyone who heeded the warnings and took the guidance has done extremely well, while most people are in the red. So that's the bottom line here. So, everyone has different opinions, but so anyhow, you can screenshot this. But the only reason I'm pointing that out is just to say that the reason I do this is strictly to help people. These videos, it takes a lot of time to compile the data to get not necessarily even this information, but a lot of the information I do get from my videos, and I want to help people excel and do well. And anyone who's heeded my warnings and taken my advice has made a lot of money and mitigated their risk and not lost a lot of money, while most people are in the red. So that's just the point I'm trying to get across. And again, because I didn't mention this specifically, I just want to point it out. Of course, inflation has hit levels not seen in 40 years, and mortgage rates are rising with it. So I just want to highlight this because, again, mortgage rates, I believe interest rates are going to keep rising, mortgage rates with it, and this is not good because everyone's going to be getting hurt with not only high interest rates and what I believe is higher interest rates, but then the rising mortgage rates, and then you're going to be getting hurt with high interest rates. So get prepared, and just keep in mind when the Fed starts raising interest rates expected in March, they will also have to consider the overall health of the financial system, including the housing market. So I want you all to keep that in mind. They don't want to create instability in the financial markets in the pursuit of bringing down inflation. And again, how this plays out exactly is yet to be seen, but I do see inflation getting worse, and I do also see mortgage rates getting worse. And again, when interest rates start rising, again, just please keep in mind that is a warning sign for the housing market. And regardless of anyone says, I do believe the housing market is in a bubble. And again, I'll just come out and say it. I don't believe exactly what they have reported. I'm not going to got our bets placed and whatnot. So I hope you all enjoying your night watching the Super Bowl. But I got it catching up to do on video. So anyhow, where I left off, I was saying interest rates have hit levels not seen in 40 years, and mortgage rates are rising with it, which the reason I brought up my post. The point I'm trying to get across is I feel everything going on now is what I predicted. And that's why I often say sometimes go back and see videos I posted previously, because that's basically everything happening now is what I feel I predicted. And that's why I was trying to get everyone prepared back in November, because I foreseen all of this coming. And that's why I'm doing this video, to get you all ready for what I foresee coming next. But again, the 30-year fixed rate average increased to 3.85%, highest since March 2020. So let's keep it moving here. And sorry if I'm repeating myself for anyone. I tell you, I get so many screenshots, and as the days passed, I'm compiling more data for more videos. So if I repeat myself, I'm sorry about that. But when the Fed starts rising rates expected in March, they will have to consider the overall health of the financial system, including the housing market. So this is something I mentioned in the past as well. They don't want to create instability in the financial market in the pursuit of bringing down inflation, which is why I said I see inflation getting worse, interest rates, mortgage rates rising. It's all a problem. In layman's terms, things just aren't looking good. And employment numbers are another big driver of inflation. And of course, you all know this information I had pre-prepared, but when it was reported by the BLS that the economy added 467,000 jobs in January with the unemployment rate at 4%. That wasn't expected after the economic shocks of the pandemic, which I'm just going to go ahead and put it out there as I believe it. I just think the Fed fudged these numbers. I do not think that the employment rate magically tripled from December to January. So that's just how I feel about it. It was an effort, in my opinion, to avoid stagflation, which is the worst inflation for the Fed to recover from. And this is just basically to highlight that the reading of 7.5% inflation was above the forecast of 7.3%. And yes, Joe Biden needs to get it under control. We're going to come back to some of this other information here and jump into historical U.S. inflation. So let's take a look at this here and to give you an idea, but we're going to take a look at historical annual U.S. inflation. And again, basically, I see inflation getting much worse as the Fed and Joe Biden drag their feet to start raising interest rates. Obviously, inflation is going to get worse, and mortgage rates are going to get worse, right? So this gives you an idea historically how inflation can get away from us and how that balance can affect everything. Now, in our case, I will tell you, and as I believe I put in my post in November, I see around 2006 being a really bad year, but I don't want to get too much into that. Right now, what I want to talk about is when the Fed starts rising interest rates, like what I see around 7 times this year. I think they really need to do it twice in March to start offsetting inflation. It's just really not looking good here. As I said, there's going to be an initial upset when they start rising interest rates, regardless of the inverse relationship between interest rates and inflation. And it's just going to cause upsets in the market, and it's not good. Like I said, it takes a while for the balance to occur. So basically what I'm trying to say is, we suffer from stocks going down from high inflation, and we suffer from most stocks going up from high interest rates. It's going to take a while for this balance to occur. In the meantime, most stocks are going to suffer. So we're going to cover what stocks you can, what sectors benefit from exactly what's going on in the economy. Now, I want to take a minute to go over the Condor-Teeth seasons. Now, as you see, runaway inflation turns into disinflation, de-inflation, start of inflation, etc. Now, if you look on the corner of each section here, it tells you the best investment depending on where we're at, right? So I want you to consider taking a screenshot of this. We're going to be going over a lot more as well. And here's another chart that gives you an idea of inflation, disinflation, and deflationary period. Now, here's a chart with recession indicators with the inflation rates and deflationary episodes. We're going to look at the U.S. inflation rate and post-recession periods because, again, I said looking forward, I want you to have some identifying things to look for. So this says recession indicators and with the inflation rates. So you have to keep in mind, again, inflation disinflation and deflationary periods, it happens in cycles. So that's why I want you to keep this in mind. And just, it points out the deflationary episodes. And although, past indicators are not indicators of exactly what's going to happen in the future, it does give you somewhat of an idea to look for. And again, if the Fed can circumvent a recession in 2022, I personally strongly feel that we will have a recession in 2023. We'll see. Again, it's difficult to make an accurate prediction when you don't know exactly how the Fed is going to react. So all we can do is review what's happened in the past and look at how, to react to that information as it unfolds, right? So let's keep it moving. Now, as employment numbers change, because they never stay the same, right? I just want to give you all an idea of what to look for in the Phillips curve. This is the short run trade-off between inflation and unemployment. As I mentioned, the inverse relationship, which is the negative correlation between the rate of unemployment and the rate of inflation. So you all can read the rest of that. We need to keep it moving because there's just a lot to go over. Now, this is deflation's economic spiral. If you all want to take a screenshot of that, it's good to take notes. Again, it's to see, just get ready when you start seeing these signs. You know what to look for here. And, this is a small piece of the pie, but, be prepared, not surprised. Obviously, right now, we're looking at high inflation, right? But you need to be prepared for the next cycles. So that's exactly what I'm trying to get you prepared for. It's like back in November when I was warning of what's going on now. No one wanted to get ready because they're like, well, that's later on. That's not happening now. So that's what I'm trying to do here, get you prepared. And again, I mentioned stagflation, unless unemployment goes way up. So, with the coming economic crisis, you can, again, screenshot, we're not going to have time to go through every single piece of advice, but, you can see here, there's a lot of factors. I tell you, there's about 30 other screenshots I wanted to go over, specifically why I think there's a big possibility we could avoid a recession in 2022, and it won't go on. We won't see it until 2023. However, just I wanted to highlight the differences between the economic crisis and the financial crisis, because it's important to know the difference, and it's important to know how to react to what we're dealing with here, because where you put your money during these times is it's going to differ. So just be prepared here, because I do feel they will both become a reality, one after another. Economic crisis, then a financial crisis. So again, I know this is down the road, but as I always say, be prepared, not surprised. Proper planning prevents poor performance. Now, because we're looking at interest rates going up, when the Federal Open Market Committee changes the interest rate, it impacts both the economy and the stock markets, because borrowing becomes either more or less expensive for individuals and businesses. Any impact on the stock market to a change in the interest rates is generally experienced immediately, while for the rest of the economy, it may take about a year to see any widespread impact. Higher interest rates tend to negatively affect earnings and stock prices, with the exception of the financial sector, which is why I suggested a consideration in Sophie, and I'm going to be trying to get out some other financial suggestions as well when we're looking at higher interest rates. I'll do my best to get those suggestions out. Same for my suggestion in oil companies with the Ukraine and Russia tensions. The Federal Reserve influences the federal funds rate in order to control inflation. By increasing the federal funds rate, the Federal Reserve is effectively attempting to shrink the supply of money available for making purchases. This in turn makes money more expensive to obtain. Conversely, when the Fed decreases the federal funds rate, it increases the money supply. This encourages spending by making it cheaper to borrow. The central banks of other countries follow similar patterns. Below is a chart that shows fluctuations over the past 20. This is a chart that shows fluctuations of federal funds over the past 20 years. So maybe just take a minute to screenshot or absorb that. We're going to keep it moving. What happens when interest rates rise? When the Federal Reserve acts to increase the discount rate, it immediately elevates short-term borrowing costs for financial institutions. This has a ripple effect on virtually all other borrowing costs for companies and consumers in an economy. Because it costs financial institutions more to borrow money, these same financial institutions often increase the rates they charge their customers to borrow money. So consumers are impacted through increases to their credit card and mortgage interest rates, especially if these loans carry a variable interest rate. When the interest rate for credit cards and mortgage increases, the amount of money that consumers can spend decreases. So again, that's why I told you, we're facing problems with high inflation, then we're going to be facing problems with high interest rates. We're going to be facing problems with high mortgage rates. Ultimately, this is a warning sign for the housing market. It's just not looking good. We're going to have to keep a close watch on everything. But again, not financial advice, trade and invest at your own risk, but be very careful. As I said, oil sector, financial sector, put options, mitigate risk. Be very careful. None of this is necessarily bad for squeeze plays. It just depends on your risk tolerance. Let's keep it moving. What happens when interest rates fall? Now, we're not going to waste time going over this because we're not there yet. So if y'all want to take a screenshot of this for future reference, go ahead, and we're going to keep it moving. And what I mean by that, interest rates are already down. So they're not falling. They're already down. But so we can go ahead and go through this. When the economy is slowing, so we've already been through this, right? They've already lowered the interest rate. So when the economy was slowing, so they cut the fund rates to stimulate financial activity, right? A decrease in interest rates, the opposite effect of a rate hike, right? So investors and economists alike view lower interest rates as catalyst for growth, a benefit to personal and corporate borrowing. So it leads to greater profits and a robust economy. Consumers spend more, lower interest rates. They can finally afford to buy that new house, send kids to private school. Businesses enjoy financing operations, acquisitions, expansions, cheaper rates, increasing future earnings potential. Boom, higher stock prices. So that's all I meant by that, is that we already have the low rates. They're not in the process of lowering rates. So to reiterate what I meant by that, the feds are not in the process of lowering interest rates for a booming economy, right? So we're not going to see interest rates being lowered and looking at a booming economy. So that's what I meant by that. So when interest rates fall, interest rates are already low. We're going to be looking at interest rates rising. That's what we're looking at. So I just don't want anyone to say, what do you mean not a reality? Interest rates have fallen. They are low. That's all I was saying. Yes, interest rates are low, but we're not going to be looking at interest rates being lowered and this in turn leading into a booming economy, because the next step is interest rates going up. First inflation shooting up, mortgage rates, and then interest rates going up. So it's just, hopefully I'm understood on that. Now, particular winners of lower federal fund rates are dividend-paying sectors such as utilities and real estate investments, trusts. Additionally, large companies with stable cash flows and strong balance sheets from cheaper debt financing. So I'm sure you all know that, there's a lot of safer large cap investments out there. I'm going to try to get some more videos out for you, but if you're looking for more safe investments. I'm sure a lot of you know, and this is not financial advice, trade and invest at your own risk, but Apple, is what you might consider a safer investment. And there's a lot of good dividend paying stocks. And again, going into higher interest rates, I've already covered some. The financial sector, you have Sophie. Oil is good right now. A lot of good companies. I've suggested a couple. Marathon, they doubled their earnings estimates, and there's several others. I still have compiled data that I want to get out. But anyhow, like I said, research is key when you're building a portfolio, and you constantly have to reassess and reallocate funds depending on what's going on in the economy and how it affects the stock market. So let's keep it moving. How interest rates affect the stock market. If a company is seen as cutting back on its growth or is less profitable, either through higher debt expenses or less revenue, the estimated future cash flows will drop. All else being equal, this will equal a lower price of the company's stock. If enough companies experience declines in their stock prices, the whole market if enough companies experience declines in their stock prices, the whole market or key indexes many people equate with the market, the Dow Jones Industrial Average, S&P 500, etc., will go down. With the lowered expectation on the growth and future cash flows of a company, investors will not get as much growth from stock price appreciation. This can make stock ownership less desirable. Furthermore, investing in equities can be viewed as too risky when compared to other investments. So, and I just want to say for those of you out there, why don't I just read all this off to you? I like to do backdrops because if you want to take screenshots and you want to go back later and you want to, review this information from yourself, that's why I step out of the screen like this. You're welcome to do that. Again, this is intended to help you. So let's keep it moving. And I've already covered this, but let's talk about it again. However, some sectors that stand to benefit from interest rate hikes. One sector that tends to benefit the most is the financial industry. Banks, Sophie, brokerages, mortgage companies, and insurance companies' earnings often increase as interest rates move higher because they can charge more for lendings. Again, research, financial sector. I'll try to get out more videos on what I recommend in the financial sector. But again, research. There's a lot of good companies out there, and if you can find some that pay dividends, even better. Interest rates in the bond market. Interest rates also impact bond prices and the return on certificate of deposit, CDs, treasury bonds, and treasury bills. There is an inverse relationship between bond prices and interest rates. As interest rates rise, bond prices fall, and vice versa. The longer the maturity of the bond, the more it fluctuates in accordance to changes in the interest rate. When the Federal Reserve raises the federal funds rate, newly offered government securities such as treasury bills and bonds are often viewed as the safest investments. They will usually experience a corresponding increase in interest rates. In other words, the risk-free rate of return goes up, making these investments more desirable. As the risk-free rate goes up, the total return required for investing in the stocks also increases. Therefore, if the required risk premium decreases while the potential return remains the same or dips lower, investors may feel stocks have become too risky and will put their money elsewhere. One way governments and businesses raise money is through the sale of bonds. We recently seen this with AMC. As interest rates rise, the cost of borrowing becomes more expensive for them, resulting in higher yielding debt issuances. Simultaneously, market demand for existing lower coupon bonds will fall, causing their prices to drop and yields to rise. Conversely, as interest rates fall, it becomes easier for entities to borrow money, resulting in lower yet yielding debt issuances. Simultaneously, market demand for existing higher coupon bonds will increase, causing their prices to rise and yields to fall. Incidentally, in this type of environment, issuers of callable bonds may choose to refinance them and lock in the prevailing lower rates. For income-oriented investors, a reduction in the federal fund rate means a decreased opportunity to make money from interest. Newly issued treasuries and annuities won't pay as much. A decrease in interest rates will prompt investors to move money from the bond market to the equity market. The influx of new capital causes the equity market to rise. For income-oriented investors, a reduction in the federal funds rate means a decreased opportunity to make money from interest. Newly issued treasuries and annuities won't pay as much. A decrease in interest rates will prompt investors to move money from the bond market to the equity market. The influx of new capital causes the equity market to rise. Impact of expectations. Nothing has to actually happen to consumers or companies for the stock market to react to interest rate changes. Rising or falling interest rates can also impact the psychology of investors' psychology. When the Federal Reserve announces a hike, both businesses and consumers will cut back on spending. This will cause earnings to fall and cause prices to drop, and the market may tumble in anticipation. On the other hand, when the Federal Reserve announces a cut, the assumption is consumers and businesses will increase spending and investment. This can cause stock prices to rise. Now, I know some people are going to say, what's the value of this? You're just reading off information. I could go online and read this crap myself. Well, what I'm doing is I'm handpicking information that I think is important for you to keep in mind. So with that being said, the number of points the Dow dropped on October 10th, 2018 due to fear of higher interest rates. That said, the Dow also dropped even more significantly in March 2020 as the Fed cut rates to near zero amid the global coronavirus pandemic. So, as you can see, any major increases is a worry. So the bottom line is, and I don't want to sound like a broken record, but inflation, in my opinion, is going to keep getting worse. Interest rates, they're going to have to boom, 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 right? Keep rising them. Mortgage rates are going to keep rising. Like I said, these are all warning signs for the housing market and the stock market. It's very sensitive to what's going on in the housing market. So let's keep it moving. The business cycle and where the economy is in it, it can also affect the market's reaction. At the onset of a weakened economy, a modest boost can be provided by lower interest rates is not enough to offset the loss of economic activity. Stocks may continue to decline. Conversely, toward the end of a boom cycle, when the Federal Reserve is moving in to raise rates, a nod to improve corporate profit, certain sectors often continue to do well, such as technology stocks, growth stocks, and entertainment and recreational company stocks. That being said, keep in mind, we're in a very unique market right now. Inflation is ridiculous. In my opinion, it's going to get more ridiculous. They're going to have to raise interest rates a lot. And again, I don't want to sound like a broken record, but mortgage rates are going to go up. I just want you all to be prepared and have a hedge against your risk. Know where to allocate your funds. I want you all to be careful. Again, in layman's terms, I think we're heading into some shit here. All right, let's keep it moving. The bottom line, although the relationship between interest rates and the stock market is fairly indirect, it's not. The two tend to move in opposite directions. As a general rule of thumb, when the Fed cuts interest rates, it causes the stock market to go up. When the Fed raises interest rates, it causes the stock market to go down. But there is no guarantee how the market will react to any given interest rate change. But again, high inflation, high interest rates, mortgage rates, it's not looking good, and I just want you all to be prepared. Like you said, back in November, I was trying to get everyone prepared. Everyone was like, in the calm before the storm. What's this guy talking about, man? Everything seems good, And now those people I was talking to, they're just so far in the red, it's not even funny. And that's why I know this is a lot to absorb and take in. It has been for me as well. That's why I haven't been getting videos out. Most of what I compiled, I'm not even sharing because I have to condense it anyhow. We're really getting into where you need to be prepared and at least mitigate your risk, reassess and allocate your funds as we move into these different cycles. The federal fund rate is significant because the prime interest rate, the interest rate commercial banks charge their most creditworthy customers, is largely based on the federal funds rate. It also forms the basis for mortgage loan rates, credit card annual percentage rates, and a host of other consumer and business loan rates. So, consumers still have to pay their bills. When those bills become more expensive, households are left with less disposable income. We're seeing that now. I mean, I know of people who weren't struggling before that are having trouble putting food in their house. It's terrible. When consumers have less discretionary spending money, businesses, revenues, and profits decrease. We're seeing that now. And in my opinion, it's going to get worse. So as you can see, as rates rise, businesses are not only impacted by higher borrowing costs, but they are also exposed to the adverse effects of flagging consumer demand. Both of these factors can weigh on earnings and stock prices. And as I said, if you look over my November posts, that's basically what I was warning. Everything I'm covering, and I still have some more to cover. This is everything I was warning about, is that everything is going in the crapper, and it's just, the only thing I can tell you is you have to be prepared. If you're not learning to make money on the way down, you're in big trouble here. And anyhow, I hope I can help you to get prepared for that, because like I said, a lot of people are struggling out there right now. And that's why, even though I'm a single parent, and I'll be honest with you, I don't have a lot of extra time, but I know there's a lot of people out there struggling right now, just trying to survive, and I hate to see that. So anyways, let's keep it moving. And then I want you all to keep in mind, posted February 12, 2022, what's this about? The stock market dropped because there's something scarier than rate hikes. What they're talking about here, and I just got a snapshot to remind me, it's the Ukraine-Russia tensions as they're building. Who knows what's going to happen for sure, but it's not looking good. And again, that's why I suggested the oil sector. And again, what is the hottest sector right now? The oil sector. I've foreseen that coming, and boom, it is the hottest sector. And when rates start rising, again, it's the financial sector. We got to be prepared here, because no matter how bad things get, there's always a sector that's benefiting. And if there's not a sector that's benefiting, there's put options that are benefiting. Now, this was posted on January 23rd, but Wall Street 3rd, 2022, Wall Street is bearish on treasuries. Maybe too bearish. Yeah, we'll see about that. But I just, with the latest news, with the yields and everything, like I said, and we got to keep it moving. I'm not going to get too into every single aspect here, but it is important for you all, to do your research. So let's keep it moving. There's still a lot. Now, I want you all to remember how much the Washington Post sucks. Stocks don't rise or fall because of interest rates. I mean, I don't know how else to say this. That's just a stupid thing to say. That's why we say be careful what you read out there and listen to. Now, here we got posted. I'm sorry, this is the wrong thing. Forgive me there. This is from 2019. Sorry about that. Now, posted on February 10th, 2022, again, rapid inflation stokes unease from Wall Street to Washington. Just basically, again, highlighting, data showed prices climbing faster than expected, picking up across a broad array of goods and services. I'm charging more because you're charging more. Well, you're charging more, so I got to charge more. And I'm just trying to, this game of ping pong. I mean, inflation's getting worse. The Feds and Biden are dragging their feet. And I mean, it's just, I don't know how else to say it. It's bullshit. They got to get rising these rates. But even when they do, I just want you to know it's going to cause instability, just like inflation. And again, the mortgage rates. So like I said, I don't want to sound like a broken record, but I just want everyone to be prepared, because these economic times we're in, it's not good for investors. And as I said, foresee a crash in March. It's just not looking good. Families out here are struggling, and Wall Street knows it. You know, all this money that the Fed paid out to American families, you know what? Before, when a lot of American families were juicing money into the stock market from their taxes, don't expect that this year. And Wall Street knows that. You know, there's just, there, like I said, there's too much to cover in one video, but things aren't looking good. That helped families throughout the year, but families that are struggling aren't going to get to recover with their taxes this year. Here's some more bullcrap from BlackRock, in my opinion. Now, more about the U.S. 10-year debt yield jumping to 2% after inflation data release. The milestone breached for the first time since 2019 on highest rate of price growth in 40 years. So, you know, again, not good. Let's keep it moving. That was released February 10th, 2022. And the U.S. 10-year Treasury yield on Thursday climbed 2% for the first time since 2019 August as investors ditch government debt on the latest evidence of stubbornly high inflation. The benchmark bond yield, which serves as a reference point for financial assets across the globe, has risen 0.5 percentage points so far this year. Investors are positioning themselves for a series of interest rate rises and the end of large-scale bond purchases by the Federal Reserve, but crossing 2% marks a significant milestone for traders. The jump came after the Bureau of Labor Statistics reported that the Consumer Price Index had risen 7.5% in January from a year earlier, the fastest pace of U.S. inflation in 40 years. So I realize some of this I'll be repeating, but, you know, some of it I haven't, so just bear with me here. Especially as it now seems that policymakers have been too relaxed over inflation for the past 6 months. Yeah, you think so? Said Alistair George, chief investment strategist at Edison Group. Sharply rising government bond yields represent a pre-tightening financial conditions well ahead of any official interest rate increases. Benjamin Jeffrey, an analyst at BMO Capital Markets, said the 2% threshold was also technically significant given the market's fondness for round numbers. Short-dated yields, which are highly sensitive to interest rate expectations, surged on Thursday. The 2-year Treasury yield rose its highest level since January 2020, up about 0.2 percentage points on the day to a high of 1.59%. U.S. inflation has consistently beaten expectations, and today's inflation release saw more of the same, said Jaw Mali, global market strategist at J.P. Morgan Assessment Management. This provides a significant challenge for the Fed as it aims to keep price increase under control while at the same time sustaining the economic expansion. Following the release of the January CPI report, trader increased bets on the interest rates. The futures market now shows investors pricing in 6/4 point interest rate hikes by December. And growing odds of a 0.5 percentage point increase in March. Of course, all this has changed since this. So, anyhow, this year's surge in U.S. bond yields has come as the outlook for inflation over the medium and long term is relatively subdued, having fallen since November 2021. Inflation is expected to clock in under 3%, both 5 and 10 years in the future. According to the break-even rates derived from trading an inflation-protected treasury, the trend suggests investors are pricing in economic outlook in the years to come despite the expectations. Some analysts argue that treasury yields have been driven higher this year by increased supply. The Fed had been purchasing $120 billion worth of government bonds and mortgage-backed securities a month until November 2021, when Chair Jay Powell announced that the central bank would begin winding down the program. In November, the Fed reduced its monthly asset purchase by $15 billion a month before doubling the pace in November. And I feel like I've covered as much as I need to cover on this. I will say this. I'll be doing a video on AMC next and then Tonix Pharmaceuticals. So this is a article from Forbes on December 14th, 2021. So if you want to check that out, I think I've taken up enough of your time, but I don't think any of this will necessarily be bad for squeeze plays. I actually think it could be a catalyst for squeeze plays, as everything is bleeding. And keep in mind, there's no really direct correlation between any of this and cryptocurrencies, but that doesn't mean that the fear will not spill over into cryptocurrencies. And I really do have a lot to cover with AMC. And as far as Tonix Pharmaceuticals, I will be sending a warning out on Tonix Pharmaceuticals and what I believe will be a coming reverse split. So be looking for those videos as well. I'm very bullish on AMC. As it's getting later, hopefully I'll be able to get those videos out tonight. But if for any reason I don't, you can be looking for those early tomorrow. Anyways, you all have a great day. Thanks for watching. I think I drug this video out too long, so sorry I bored you to death. I'll try to keep them shorter in the future. I guess I just would rather cover too much information than not enough. And there's just been so much information to absorb. I actually cut out a lot of information, and to be frank, I think I should have cut out a lot more. But anyhow, you all have a great night. Thanks for watching, and I'll see you on the next one. Peace. And sorry for seeming tired in the video, but I'll see you on the next one. Peace.